Nikhil Mansukhani is now joining us from Man Industries to talk more about the numbers. The recently declared numbers have excited a lot of investors on the street because of a very strong performance. Nikhil, afternoon. Thank you so much for your time.
Good, good afternoon for having me.
So Nikhil, your shareholders and prospective shareholders are all smiling just like you are looking at the numbers. Do the numbers look durable, say, into the second half of the year? What kind of exit rate are we talking about when we close the year by?
So the numbers are very good for this quarter, and we are looking at the similar way to go forward and taking the company forward. Approximately, we should be ending the year very strong at between 2,900 to 3,000 crores, which would be almost 50% growth from last year at the revenue level. At the EBITDA levels, also, we would be approximately between 9 to 10% of EBITDA. And the PAT levels from last year would be approximately almost 100% jump on the bottom line for the company.
Sure. Nikhil, I want to understand before I come to the outlook for the next 2-3 years. You are changing your business mix into high margin business as well. By when would that start coming to effect in your numbers? One, and how structural is the demand? The tailwinds into all the 3-4 categories of segments you operate in. Do you have good visibility of 3 to 5 years on demand front?
So yes, definitely looking forward with the high margin business, which is a SS seamless plant which we are putting up. It's got a lot of demand. Ratnamani is one of them, which is the market leader for that. And we are looking forward for the SS plant to be operational by December 2024. And going forward, this is a sustainable level because I think the oil and gas, there is a lot of India outlooks looks very, very strong. Recently, HPCL laid out a 75,000 crore capex for the next 5 years. And so does IOCL, GAIL, BPCL. And basically a lot of renewable energy, which the government is looking to change and more gas-based. And now that our ERW unit, which we set up last year, is fully operational, as well as we've got all the required permissions from API and all the non-API permissions. So we are looking at a very good sustainable growth of 20-25% for the next 3 years.
At 25% growth in the next 3 years, ideally your bottom line, your top line actually doubles in that time frame, right?
Correct.
So what kind of numbers are we talking about? Are we talking about, so if you close the year with 3,000 crore or thereabout, in the next 2.5-3 years, are we seeing for 26-27 kind of a 6,000 crore kind of a top line number? And will that come on a higher margins because your business profile, your segment profile is improving towards high margin business?
Correct. So we are looking at the similar levels of between 5,500 to 6,000 crores of top line in the next 3 years. Dividend payout, yes, 26-27, once we achieve and stabilize the business, that would be the first target to achieve and stabilize the business. And post that, if there is excess cash flow in the company, we would be looking at multiple options, which could be even like a buyback or a higher dividend. But that's a call which will be taken 3 years down the line. The first focus is to get the sales up and running, get the revenues up and running, get the margins in. And then obviously, if there's cash in the company, there's a lot of things you can do when there's cash in the company.
Clearly, yeah. When one has a lot of cash, then options come to mind, isn't it? So yes, buyback could also be one of them because it increases the ROEs. But in the next 24 to 36 months, that's where your expansion is actually happening, all of that. What kind of discussions are you happening with your clients? Are you seeing higher demand from Middle East as well? Because L&T put out one of the brokerages put out a very interesting note this morning saying that Saudi Arabia is transforming and L&T could be a big beneficiary. I saw that you also have a lot of business interest in the Middle East. If indeed there is so much of non-energy capex also happening, water, this, that, so some rub-off would come to your business as well?
Yes, there's a lot of, we do a lot of work with Saudi Arabia already. And we're evaluating some things over there as well. And we have got a lot of business from Middle East over the last 5 years. Majority of the businesses internationally we are at around 70% exports business and 30% India. So we are seeing a very strong headwind for the export business as well. At the crude being at $70-$75, it's the right range for new projects to come up, and we see a lot of demand coming up in India also. Like we said, HPCL has drawn out a 5-year capex plan of 75,000 crores, which is our existing business, which we are doing day to day. For the stainless steel, there is a lot more demand it's a very high value product used in defense and pharmaceuticals. So we are gonna take the target over there slowly and get all the approvals and everything from EIL. But currently, we are looking at a very good and stable market for the next 5 years and a good growth opportunity for us.
What is your current capacity and how much are you upgrading your capacity by? And which quarter onwards the additional capacity will start coming into effect?
So existing LSAW, our capacity is around 800,000 to 1 million tons, which we are not expanding. We are just existing business. We are just trying to fill in more on the business from oil and gas and water. Compared to the ERW, it is just taken off right now. So it's at 100,000 capacity, which I think we will be around 50 to 70,000 tons this year, as in for the next coming year, because it's just got the API approvals. The stainless steel capacity would be around 20 to 22,000 tons. And that normally operates between 80 to 100%.
All right, Nikhil, great chatting. Thanks so much for giving us the roadmap of growth from here on, and congrats for a good set of numbers as well.
Thank you. Thank you so much.
That's Nikhil Mansukhani.